First of all, welcome all of the guests that are in the audience today. We have real estate friends from South Florida to Central Florida to Atlanta to the Carolinas. So welcome to all of you. And I want to take a moment now to especially welcome our guest, the reason you're here, Doug Duncan, who is the chief economist with Fannie Mae. Doug, welcome to a special edition of News You Can Use.
Thanks. Great to be here. Glad to be with you. Looking forward to some good conversation.
Me too. And I know you're a humble guy, but I do need to remind the audience that you have a trophy case. As economists go, I'm not sure what those trophies actually look like, but you've been recognized as, by Bloomberg Businessweek, one of the 50 most powerful people in real estate and one of Inman News' 100 most influential people in real estate, and you've won all kinds of other awards. So I just want to thank you so much for taking your time to join us today. All of us folks here at Supreme, obviously, and all of the real estate agents and owners, leaders that are in the audience, we're service professionals that lead consumers on the biggest financial investment that most of them will ever make, and that is called buying a home. And I'm not sure we ever really stop and consider that that's exactly what we're doing. We're kind of like leading the journey and giving them education along the way. And today is a blessing to all of us. And we're grateful that you're here because we'll pick up an awful lot of updated information based on questions and your answers. And hopefully we'll be able to package that and put it into the hearts and the brains of those that we represent every single day. And it'll make their journey in terms of home buying a little bit better. So I want to just kind of outline to the audience what we're going to cover today. We're going to really quickly cover the fundamentals that drive housing. I think when you get caught up, especially in the last 4 years of volatility, you can get, maybe some people can even be thinking about, should I be in this business? What's it going to be like in the future? And so I want to take a minute to just kind of play out what are the fundamental drivers for housing. And then I'm going to ask Doug a little bit about, where we've been, where we are, and of course, for all of our interest, where we're going. I'll warn you in advance, he's likely not going to give on the where we're going any dates because he's got a theory about forecasting, but we'll get to that in a few minutes. And then we'll talk a little bit about NAR and about Fannie Mae's, current thinking in and around it. And then finally, we'll finish with my favorite all-time question to ask Doug. But let's kick it into gear if you all are ready to rock and roll. Doug, over the years, as I've collaborated in conversation with you, I've learned a few things, tried to be the very best student. And what I think I've heard you say over the years is that the three biggest drivers for housing that we should be constantly focused on are, one, demographics, people, because people need roofs. Two, employment, because people need jobs to afford roofs. And then finally, kind of the third pillar is affordability. What's the cost of actually renting or owning the roof? So the world's been through a lot of changes and our industry's been through a lot of changes. Are those three still the key drivers for housing, demographics, employment, and affordability?
They are. Let me give you a couple of very simple things that illustrate the larger point. First of all, every human being on the planet puts their head down on a piece of real estate somewhere every night. So the real estate business is integral to everyone's life, whether it's simply how they live or if it has to do with their employment. That's true all around the globe. A second thing specific to the United States, which is the only real market where we make long-term fixed rate mortgages, is if you look at the labor data, we talk about the combination of demographics and employment. If you look at the labor data, you will see that on average, the labor employment in the country turns over every 18 months. there's this massive mobility of employment in the United States in our labor market that is really kind of unique around the world. So we make 30-year fixed rate mortgage loans when the average length of employment in the current position is 18 months. So built in there is the assumption that incomes over the long term always grow. It's difficult to make that assumption in any other economy than a free market capitalist system economy, which has proven over the centuries to be the source of growth. Those are a couple of really basic things that people should bear in mind, particularly as we're in a presidential election year. You're going to hear all kinds of policy conversations and things like that. But just bear in mind that when those discussions take place, they affect the efficiency of that system in growing incomes, increasing employment, and enabling the acquisition of assets like homes. So, bottom line is they're still true.
Yeah. So
Demographics, we've recently seen estimates of maybe 3 to 5 million more people now in the country based on recent immigration paths. And a lot of them would appear to be working and contributing to consumption, which has stayed stronger than had been expected, and has brought down some of the concerns the Fed has about employment wage rates and their contribution to employment.
yeah, you just raised a great point that I think makes less political, what is a political issue, the immigration issue, because immigration has always been, and it lowers cost of labor or mutes cost of labor, and it also creates additional demand, which is good for the economy, overall economy. So on the margin, we need to be mindful of that as the political debate, which is worthwhile about policy and all that kind of good stuff takes place. So the good news for the audience today, where you're geographically sitting, if indeed it's true that what drives housing is demographics, the South is winning in the demographic battle for people. And in fact, people are moving here at a rate that does not exist anyplace else in the country. So there's basically immigration in our cities and states, which is absolutely great for the business that we're in. Mindful of the fact that we've been in a very tough, maybe the toughest period ever for housing. But over a long period of time, if you're thinking career orientation, which all of you are, then this is a great place strictly from a demographic standpoint, because people are wanting to move here. Second, on the employment front, the nation's unemployment is just under 4%. That's the U.S. And in Georgia and Florida, we're hovering around 3.1 and 3.2, and similar in the Carolinas. So to the extent that the demographics are really favorable, and so is employment, we're kind of set up pretty well. Those things have been and continue to be kind of favorable for where we live. Not so much for other places in the country. The real challenge that all of us have gone through, and we'll talk about this with Doug here just in a second, is the combination of increased cost of housing over the last, call it 4 years, unprecedented in some ways, and in combination, the increased cost of interest rates that was sudden, if you will, and radical, has in fact affected affordability. We're at a point right now where affordability from a housing perspective is it's not at an all-time low, it's kind of near an all-time low. Doug, is that a fair way to think about where we got this slowdown from the overall housing marketplace, just the affordability front?
It is. We saw during the pandemic a move to space to avoid the risks of the disease. That was enabled by historically low interest rates, which households took advantage of and moved. Perhaps I would argue that what we're seeing this year and last year were the absence of the people who moved up during the pandemic earlier than they would have moved by the incentives of the fear of the disease and the work from home permissions and the very low interest rates. So that pulled a bunch of business out of the 23 and 24 that will only slowly come back as those mortgages, which are 3 to 4%, start to run off. So um, uh, no question, the rise in rates because of, in part, all of those transfers that took place from the federal government to private parties gave them more funds to spend, and the supply side of the economy wasn't moving as fast. That pushed up prices, known as inflation. And the interest rates, of course, go up because they contain an inflation premium. So the house prices increase because of the demand and the very low levels of interest rate. That resulted in some inflation, which the Fed then tightened to attempt to take control of that. And surprise, surprise, house prices didn't fall because there just isn't the supply.
And a lot of that, when you think about the ingration or the move demographically into the Southeast, getting out in front of supply on housing. First, you had the breakdown in supply, which was COVID period for builders and building housing and the cost of all the commodities that go into it, and then labor, et cetera, et cetera. And now you're just trying to play catch up over time, which I guess is a little bit of what the Fed does when they choke the economy down or destroy demand, is they let supply side do catch up. For the audience purposes, just contextually, in 2018 and 19 BC, before COVID, we were running annual housing sales just over 5 million a year, like 5.3 million annualized sales per year. And we're back now in 18 and 19. And, Doug told me earlier today that in his recent fun that he was having with Economist out in California at a couple of cocktail parties, they don't use normal anymore when they're talking about anything, I guess. But 18 and 19 were BC, before COVID, and before the period we were just describing, where people were staying at home and there was stimulus given and rates went to all-time lows. And then we left 5 million a year in sales, just over 5 million, and we kind of got up into the 6+ million, almost at one point, almost 7 million sales on an annualized basis, which is taking those sales, as Doug described, from what would have been 23 and 24 and dragging them into an earlier period. So if you had a great celebration in 21 and 22, sometimes you celebrate on Friday evenings and then Saturday comes, right? And I think 23 and 24 have represented Saturdays. Doug, we're at now 23 and 20, 22 and 23. We had 8 consecutive, correct me on this, quarters of housing sales declines, which a recession is two quarters. We had 8 quarters of declines. Has that ever happened before?
Yeah, it has. If you, I'm trying to think of the exact time frame. I'm not sure, actually, if it's been 8 quarters. We've had a couple of years, but perhaps not every quarter in those years when that's happened. So it's pretty unusual. On the chart that you had up there, if you look at that and you sort of mentally clip off the tops of the 2020 and 2021 data and tip them over into the 22 and 23,
they normalize.
It comes pretty close to maintaining a level period. That's what I was talking about pulling forward in time the business because of those low rates in the response to COVID. So we're coming back closer to something normal. What we've said, what we have said is our view is that 4 million existing home sales is kind of a bottom, that just life changes alone require people to make transactions irrespective of what prices and interest rates are doing. And our thought is that about 4 million existing home sales annually is sort of that floor. We just tipped under it just a little bit, one month and maybe 2 months, but so we're coming off that. The bottom line is the future will see growth. One suggestion not to overly be concerned about interest rates is if you go back to the early 1980s, the late 70s and early 80s, when mortgage rates were 15% or something like that, homes were still selling.
Yep.
It wasn't that they just went away because interest rates were high. What the key is the relationship between interest rates and incomes. And to your point about the rapid rise in interest rates, incomes don't rise that rapidly. So households are starting to adjust. Our surveys of consumer sentiment in the last 4 months or so look to us like consumers are kind of taking a temporary wait and see attitude. The numbers are kind of flat over that time period. So it's like they're kind of waiting to see which way are things going to break before they make a move.
I think great for the audience to hear your mention about historical interest rates, because 7 for the most recent period, call it 5, 10, 15 years, is high, but in relative terms to a 50-year period of time, on average, 7 is about average. I asked you a question one time 3 or 4 years ago when no one would have contemplated a 7% 30-year fixed rate mortgage. Imagine that. But I asked you a question about, do rates really matter? And you said not unless they move really quickly, because they then, as you just mentioned, go up faster potentially than incomes do, in which case affordability, the third leg of the stool that drives housing, gets under pressure. And that's exactly what we saw take place. We saw rates move precipitously higher on the heels of the inflation kind of onset that took place, which of course was going to be transitory until it wasn't. And even that, we don't know what that means, right? So, but I think that created a problem. Doug, a question just in terms of the number of households in America today. You know, if you took interest rates out just for a minute and all the stuff that we've gone through, you know, we were doing 5.2 million units in 18 and 19. We got up to high 6s annualized, maybe even kissed 7 on a quarter or so. Now we're down, you know, late last year, you know, to 4 million units, a smidge below, as you said. What in your way of thinking, roughly, right, what's kind of a normal number that we would look to? Like, if we're way below norm now because of the happenings, and we were above it during the COVID period because of the low interest rates, the stimulus, and staying at home, what's a normalized number based on households that we have?
Probably somewhere in the 5.25 to 5.5 million. If some people look at the homeownership rate and use that as a guide, it's a little bit misleading. Part of the reason is the boomers are this huge population group, and their homeownership rate is 79.5%. So the national homeownership rate is about 65, which is pretty close. 65, 66 is about its long-term average. But now you have this huge population group, the boomers, with a homeownership rate of almost 80%. So the question is, what's going on with homeownership rates at younger groups? One of the things that you have seen is that the median age of first-time homebuyers has moved up in the last 2.5 or 3 years because of this rise in rates and prices. So they're having to stay renters longer to accumulate the savings that allow them then to be able to make the home purchase. So that average age has moved up from something like 31 to about 34. I think I'm quoting this kind of off the top of my mind, roughly in that nature. That's the impact of the affordability constraint to the first-time home buyer.
Well, Doug, we're comfortable with you just quoting it like that because anybody who has a bobblehead, after all, okay, is pretty impressive. And the series before
that is artificial intelligence. That's what that is.
So help us on this. There's much to be said, or there's a lot that's said about the younger generation. Of course, as it goes, when people get older, there's always something said about the younger generation, generally not as favorable. But when you all at Fannie do your surveys and you're identifying that home ownership group, that expanded group right now, the biggest one that's ever been out there, are they telling you that they still want to buy homes?
Oh yeah, absolutely. There, if you divide, we can divide our surveys by age groups and by owners versus renters, and there's no abating in the desire of American households to own a home. That there's been no change in that. Their ability to afford to do so at any point in time is challenged. And I will say, one of the things we're taking a look at is the supply issue has actually been under development for something like 25 years. It was a little bit disguised by the great financial crisis, which was really an underwriting issue, and it was also impacted by the pandemic. But take, for example, new home construction. This is a great, in terms of looking at the supply, this kind of shows you what the current issue. But if you look at the new home supply by size, the uh, traditionally it was viewed that a starter home was about 1,400 square feet. Only 7% of the homes built in the last year were 1,400 square feet or less. So there's been a structural change in what households are expecting to purchase. Part of it has to do with the rise of general prosperity in the country. I grew up in a bedroom and lived in a bedroom with two brothers, and I had to sleep with Bill Cosby had a record called "To My Brother Russell, with Whom I Slept." Well, that was me. My brother Russell and I slept, and we had a line down the middle of the bed. Don't cross it. Well, today, today, all of the siblings have their own bedrooms, or in many instances. So those homes are much bigger. Well, necessarily they're more expensive. So to some degree, it's social change that has impacted things. A second side of that affordability is that the rise of women's workforce participation to equal that of men has meant that house prices today actually expect two full incomes in a household. So you may, if you went back 30 years, that was not true. And so the rise in housing costs has reflected the social structure change uh, of those two attributes of households that are different today than they were 30 years ago.
We must have grown up in the same neighborhood because yeah, I grew up and bunked with my oldest brother Tom, which I thank him so much because in 1976 he slid in it wasn't even an 8 track, it was a cassette tape of Aerosmith, and I told him it changed my life. Thank you so much for doing that. So the benefit of sharing rooms with the brother, right?
There you
But
go.
it's interesting. I do think we own a lot of house and in a lot of cases don't even use the whole house. And maybe that's going to be one of the things over time that will reorganize itself in and around this affordability issue. Let's talk about our favorite friends, the Fed.
Mhm.
By the way, listen, I'm for everybody, not for everything, but I'm still for everybody. So I'm for the Fed. Um, First, why don't you just take a minute to describe, Doug, for everyone in the audience, what exactly the Fed is and what do they do?
Well, our Federal Reserve System is called a central bank. It is a quasi-governmental entity that's responsible for managing the money stock. And they have two primary objectives, one which are called their dual mandate, which is a stable price level. That's a reference to inflation. And the other one is maximum employment. So the maximum employment part was added in 1978 in a bill called the Humphrey-Hawkins bill. Before that, the sole objective of the Fed was to prevent the emergence and continuation of inflation. So their primary tool is interest rates, and it's the federal funds rate, which is the interest rate at which banks lend to one another overnight. And when they raise that rate, it constrains economic activity. When they lower it, it eases economic activity. Today, we've gone through a period over a couple of years of going from essentially negative interest rates adjusted for inflation to positive interest rates over the last year, but significantly higher nominal interest rates. That is the interest rate that includes both real rates and inflation. So the fastest increase ever I'd see on the chart. I would agree with that. Um, they're so they're at present holding their position, believing that this rise in interest rates as it works through the economy as a cost to both households and businesses, and additionally to investors, will slow economic activity. And to this point, they've definitely brought inflation down compared to the peak, but they also set a goal of inflation being at 2% measured by the core purchase consumption estimate, PCE. It's not there. And they were making good progress. The market was optimistic the Fed was going to start to cut. In fact, in December, at his press conference, Chair Powell essentially took a victory lap, and the market immediately, within a week, the market had gone from expecting one or two interest rate cuts in 2024 to 7 interest rate cuts. And I remember remarking to our executive team, I said, you can expect tomorrow the Fed will start to walk that back. and of course, while inflation was coming down, all of a sudden, 3 months ago, it started a slight reversal. And for the last 3 months, inflation has actually picked up a little bit, which has put off those hopes of interest rate declines now for some time. You can see, yeah, you've got the right chart there.
Yep.
And of course, this week, everybody is holding their breath. On Thursday, the CPI comes out. Today, the PCE came out. I'm sorry, not the PCE, the trade, what am I trying to say? The wholesale inflation numbers came
PPI,
out,
yep.
PPI, and they were up. Now, they were not up as much as the headline suggested, because the past data were revised actually to a negative level. So the total increase is not as much as the headline says. Nonetheless, the direction is not the direction the Fed would like to see it move. If that's supported by another even small increase in inflation in the CPI data, I would probably think about changing our current forecast call of 2 rate cuts, being in September and December this year, to taking one of those out. I think that my current thinking about the Fed is they would like to get 3 consecutive months reversing the trend of the last 3 months in May, June, and July. Then in August, if they go to typically the Kansas City Fed hosts a meeting at Jackson Hole, which is a discussion of monetary policy. They would like to be able to signal at that meeting that they would then cut in September. If they don't get a good number tomorrow, I think that game changes.
So they've got 2 mandates. Employment at this point is under 4, so very, very sound. And so they're basically firefighting now this inflation fire that started a couple of years ago. We peaked out close to 9. We've dropped down very quickly down into the 3 handles, and everyone kind of celebrated around Christmas time that maybe we were going to get the rest of it this year. And of course, as you just described, the rate cuts that would follow. And and kind of get back a bit to a lower rate environment. So the things that you're watching right now sounds to me like CPI tomorrow, which is the Consumer Price Index. Take a minute to tell us, because you've told me in the past that there is a larger housing component in CPI than is in the Fed's preferred inflation idea, PCE. But just for CPI, which comes out tomorrow, which will be a big news story because of inflation being the biggest news in the economy and where the Fed's at with rates, et cetera. Talk to us about CPI and about specifically the kind of the weight of housing and how that's affecting it.
Yeah, in the CPI, housing is about 30% of the measure of inflation. And it is composed of rents on apartments and also on something called the owner's equivalent rent, which is a jargony way of saying what you would have to pay to rent the house that you currently own. There's lots of controversy about the efficacy of that measure, but the bulk of it is actual rents. And one of the things about actual rents is typically they're on a lease. Leases are roughly 1 year. Some of the single family rental business is maybe on month to month as opposed to the annual leases. But the rent component adjusts over time as leases are renewed, which is the reason that it lags the changes in inflation overall. It's something that that contractual relationship leads to a lagged implication. It's been expected that that would ease, and in his last press conference, the Chairman Powell was specific in saying it has those lags have been longer than we anticipated, and there is still some uncertainty in their mind in over the time in which that will actually reveal itself. In the meantime, people are looking at, well, what if you take that out? What so they're you've taken out food and energy. What if you take the rents out? What does the services component look like? And it's actually increased. So I made a joke. I said that, so they call that piece where they take housing out, they call that the super core.
Yep.
So I said, well, I'm going to make the super duper core. And if you
Okay.
take all the data out, there's no inflation. So,
Right.
but if you're thinking about it, people drive to work, so that gas is kind of important. They eat, that seems important, and they live under a roof. That seems pretty important too. So, I'm making a kind of a half joke. You can't take everything out. There is a forecast team that operates. They're more of a political team, but they operate in DC that I respect, and they track about 50 specific components that are pretty central to people's lives. And those, looking at those, they are still accelerating at over 4%.
Wow.
So when you see the stories about people being angry about inflation, you can go back to my Uber driver to explain it. So I was going to the airport and he asked what I do, and I told him, and he's like, well, what do you think about this inflation? I'm really hacked about inflation. And I said, well, tell me what you mean by inflation. And he said, well, look, have you looked at the price of food, how far it's gone up? And he said, it hasn't come back down. Well, that's a very clear statement about how inflation actually impacts families at the breakfast table. So economists think about inflation and describe it as the rate of change in the general price level. But households very reasonably see prices go up and their income has not gone up to accommodate that price increase. To them, that's the practical implications of inflation. So the stories that you see about people being very unhappy, even though GDP is good and employment is good and all these journalists are writing, well, why are people so upset? Well, that's why they're so upset, is their incomes have not caught up to the price level change that took place. And that's a great headline. That's exactly what people are reflecting
Yeah,
in their
so,
life.
so basically, the average consumer who's carrying credit card debt in America is paying more for the debt, outstanding debt that they have. And then when they go and actually buy the goods and services that they buy, they're paying more for that, juxtapose their income, not justifying them being able to do that. You know, it feels like at some point, the Fed keeps interest rates here. The conclusion has got to be that consumers just slow down spending, and we get, you know, to a different place, recession or otherwise, because the outcome can't be any different.
Right.
Is that
Yeah.
is
This is why the Fed is they're very focused on the inflation issue. They are, however, interestingly, Chair Powell in his last press conference made the statement that as progress is made on one part of the dual mandate, it's reasonable to start shifting your thinking to the other part. So while they haven't fully gotten inflation to where they wanted, he was saying we are rebalancing our thinking to be focused on what's going on in employment, and he pointed out some of the places where there has been some weakening. I think, excuse me, I think you and I talked about the fact that we had in our forecast for the better part of a year that there would be a recession that would start in the third quarter of 2023. And if you look at the goods part of the economy, take out the services piece, look at the goods part. We were watching employment in the private sector decline period over period. It has held up because the government employment plus healthcare has held it up. The last couple of months, December and January, we got two strong private sector growths in employment. But prior to that time, you were seeing the goods part of the economy, I would argue, was already in recession. And I think everybody on your call would say real estate has been in a recession.
I say so? Yep.
Right. So that I think that part of the story was true, but the all of the transfers to state government, for example, which is teachers and police officers and firemen and all that kind of stuff, that plus the healthcare space is what held it up.
Yeah. So, by the way, for the audience, if there's any praying types out there, I'll just give you my point of view on this. The Fed's mandate is employment and inflation. I cannot pray in good spirit for people to be unemployed, which would be helpful for inflation. But I can pray for inflation to come down. So if you'll join me with the prayer of lower inflation, I think we're safe there because that benefits everyone. Doesn't think
Right.
it does any harm to anyone. So, all right, Doug. So, one of the questions I've always wanted to ask you, does the Fed ever get it right? Or is it impossible to get it right because there's just too many moving parts with regard to policy and policy management?
They do. There's been a couple of instances, one in the late 1960s and one in the mid 1990s, where they did create a soft landing, which is defined as bringing down the rate of inflation to the level they view as tolerable without a significant run up in unemployment or a recession. So they have done it a couple of times. One of them was the most recent one, and the one that I have a personal memory of was under Alan Greenspan in 1994-95. And one of the cues there was he perceived well before anyone else that there was a significant productivity burst that was underway from the computer technology development aligned with the internet that substantially increased productivity for several years so that the Fed did not have to tighten further because that productivity was working off the changes in price level. So he therefore halted the rate increases earlier than some other points in time. I was just going to ask, is this Ty that's bringing these things up on the
It is
screen?
Ty, who's a
That's a
master.
great.
Yeah, he's masterful at catching the right thing at the right time. And
Yeah, that's rock star. Good
yeah, no,
stuff.
he is a rock star, as you know. So
Absolutely.
good stuff. Um, so, obviously you and I share a faith. And one of my favorite pieces of scripture, and this is for everybody in the audience, independent of whether or not you share the faith or not, hope deferred makes the heart sick. When we as people are not hopeful about our futures, either in our personal life or in our professional lives, we're filled with anxiety and depression. And in our business, in the real estate business, the last 2 years, I've been doing this for 39 years now. This has been the most challenging desert season experience that I've ever experienced. Now, prior to that, of course, 2021 was the best 2 years ever. And then the last 2 years have been fascinatingly challenging. But today's about creating a little hope. And I invited Doug, amongst other things, because Doug, your recent forecast for the go forward, not where we've been in the desert that we've been in, but the go forward does do just that. This is a document that Ty will put on the screen. I think you're familiar with this. Oh, that's right. You actually create this. That's why you'd be familiar with this, right? So maybe if you could walk us through total home sales, kind of where we're at this quarter and then going forward into 25. And then also maybe price appreciation. And you also have an interest rate level that you've tagged in
Yeah,
each one
sure.
of these quarters. So go ahead.
Yeah, sure. We just a point so that if you do come out and look at the forecast, we update it every month. Usually goes public about the 15th. So the May forecast will be coming up shortly. It won't look appreciably different from the April forecast, although rates are up just a little bit. The rate structure in this is to harmonize interest rates across the company. We use the forward curve, the forward interest rate curve from the last business day of the previous month to build what the rate structure will look like. So sometimes if it's the 30th of the month as in April, if that was a business day, then the next week, if some important news happens, rates could move 20 basis points, and you would look at that and say, well, gosh, the forecast is wrong. It's even before they put it out. Well, it's partly because of that construct. So, but over time, that's turned out to be a pretty good discipline for the longer term outlook. So the what this represents really is that 2023 was pretty much the bottom. 2024 and 2025 start this gradual improvement in the number of sales, and also to some degree some improvement in refinances eventually. It will be slow, in part because there are so many people that currently are homeowners that have an interest rate that's substantially below what current market rates are. And of course, rationally, they're not inclined to give that up. Although in speaking about this, I've made comment publicly 2 or 3 times that some of the people who have those 3 to 4% mortgages will actually become investors because life circumstances will require them to move. They may well keep that home as a rental because in many markets, the payment on that mortgage will be less than what rents are in that market. And they can use the differential to subsidize the mortgage payment in the house that they go to if they take another mortgage. And I've had 2 or 3 people that have come up to me afterward and said, that's exactly what we're doing. We're going to do, at least for the near term, we're going to that's what our plan is. So people are endlessly creative in how they manage their household finances, and I never prejudge people's decisions because they have unique circumstances, every household. So probably in 2024, I think what we have here is about a 4% increase a little over 4% increase in existing home sales, about a 4% increase in new home sales. In 2025, some additional improvement, maybe another possibly 10% increase in total home sales, a little more on the single family than on the existing home side, but still pretty strong. This assumes that the Fed gets control of inflation. They're getting a control of inflation, brings the 30-year fixed rate mortgage back down to around 6% by the end of 2025. So let me talk about that rate for just a moment. I know, Pat, you and I, if not publicly, at least personally, have talked about what would be a reasonable thing to expect longer term or for 30-year fixed rate mortgage rates. So from World War II, let's say from the time the VA was fully operational until the year 2000, the 30-year fixed rate mortgage over that time period averaged about 6%, 5.9%. So today's rates, even at 7.25 or whatever they are at the moment, are not that far from the long-term average. So bringing down from that 7.25 to 6%, if incomes are rising over this time period, so we now have, that's 18 months from now to get to that place where rates might be 6%. Incomes are going to rise over those 18 months. They've already risen over the 2 years, the second half of 22 through the first half of 24. They've already risen during that time period. So you will have had 4 years roughly of income growth that suggests many more households will be capable of handling a 6% mortgage, which is part of why that 25 number starts to accelerate relative to 2024.
So the good news is we pulled sales forward into 2021, 22, halfway through. That would have happened. We didn't get those sales in the last couple of years. And now we're in that place where the Fed is maybe hopefully at the final battle or so of getting inflation to get to a lower rate, which will bring our rates down some. And your forecast reflecting that shows housing sales up 4% this year over last, which is, thank God, we're up. And then another increase the following year, provided that they do get this thing under control as has been expected. And it feels like, it roughly right. It's been moving in that direction, not exactly and as quickly necessarily, but it's moving in that direction. You see housing appreciation. I'm looking at your numbers. You all are thinking about like a 4.5, 5% appreciation number this year and less than that next year.
Yeah, if you going back to that pre-2000 time period, if you look at house prices during that same time period, the average house price appreciation was about 4%. So, and if you assume that at some point supply catches up so that the bargaining power is roughly equal between buyers and sellers, a 4% annual nominal appreciation in house price is certainly reasonable. What I would say the one thing to think about is during that time period when interest rates were at 6%, the economy was growing at about a 3% annual pace in real terms. So if you think forward from today, the Congressional Budget Office makes a formal estimate of the potential growth of GDP, and they forecast it at about 2%. So you had growth at 3%, nominal mortgage rates at 6%. If you bring that, it suggests if it's a 1-for-1 shift in the relationship, a 2% real growth would get you a 4% mortgage rate. I think that's probably hopeful thinking. The one question is, will this new technology accelerate growth? So that's a question of whether growth will be a little stronger. But these huge deficits that we are running and the huge debt that will have to be paid for, we believe will also push interest rates up broadly across all markets.
Got it.
So, so
So
I
there's an
would,
offset. There's an offset to the lower growth, which is more debt that has to be issued, which will keep interest rates somewhat higher than maybe what otherwise would take place with that GDP.
right. I
Um,
might think of a long run, maybe 5.25 as being a median price across the cycle.
when I look at this and I talk with people, particularly in the real estate business, because they're not obviously in the housing finance, so they don't participate in the refinance side of things at all. But if you just thought about real estate, you really don't want rates to drop, a point or a point and a half overnight
No.
because we don't have enough inventory. We'll get back into that circus that we were in, where we're bidding up prices and multiple contracts, which is, in some ways is fun, but it's a little bit like being out on a Friday night, staying out a bit too long. Saturday comes always after that. I'd rather see us get back into your forecast is a perfect forecast kind of where we drift lower on rates and values temper and we get a slow but sure increase in demand. It feels like that's our kind of forecast. And
Yeah, I
if that
like to be
happens,
able to read the Saturday morning Wall Street Journal
there you
comfortably.
go. That's exactly right. So let's shift real quick. There's kind of a substantial earthquake in real estate. I have my own views that it's louder than will ultimately be at some practical level for buyers and sellers. My view on NAR has been from the beginning hearing it that I bought a number of homes in my life and have been served incredibly well by the real estate community on the buy and the list side, regardless. And for the most part, consumers have been extraordinarily satisfied and happy with the buy and the list side. Lower cost options have been out there forever. I won't go any further into that. But one of the questions that our audience asked me to ask you is, the NAR news with regard to buyer agent commission disclosure that's going to take effect this summer, and in some ways is starting to take effect almost as we speak. Does Fannie Mae care about this, and what do they care about specifically to it, and any views that you might want to share with regard to thoughts about it?
Well, we don't. We certainly care because it's part of the cost structure of housing, and we have an affordable housing mandate that the company is held account to publicly. So we certainly care. We don't deal directly in that space, but certainly it impacts the lenders that we do business with, who do business with the realtor community, and of course there are financing components, decisions that can be made in that the financing space. Now, it won't be an issue of Fannie Mae making a public statement about things that would go through the regulator. We're still in conservatorship. So any decisions that would be made about changes that would impact the company and responses to that would actually come out of FHFA. So it's not as though we're unaware of it. All the court issues are not settled yet. So it's difficult to draw a firm conclusion about what might happen since we don't know what all the rules are yet.
Yeah, so for the audience, Fannie cares about this because to the extent that anything could increase cost to specifically a first-time home buyer, vis-a-vis down payment, et cetera, and they have a mission to ensure that home ownership continues to take place. That's where we would potentially see some happenings, but that'll be deferred until maybe this thing kind of starts taking a little bit better shape, because there's a lot of pontification about what's exactly going to happen. We know what the new rules of the road are going to be in terms of disclosure. But but we'll wait and see on that front. Doug, I again want to thank you so much for your time. Before I let you go, I have one more question to ask you, and I've asked it to you before. Here's the evidence.
I always ask, every time I've talked with Doug, I've always asked you the same question. Doug, Duncan, chief economist with Fannie Mae. Is it a good time to sell? Is it a good time to buy? But is it a good time to buy, Doug? Is it a good time to sell your home? A good time to buy a home? Is it a good time, buyer or seller, to buy a home? Is it a good time to buy a home?
So I to the audience, I think when you deal with the anxiety of your consumers because they're about to go through, forget today's concerns, they're real. But buying a home is the single biggest financial investment that most people will make in their entire lifetime. So of course they have anxieties and worries and concerns. And I always ask Doug this question because then the circumstances in the moment can increase those anxieties for consumers. And I wanted you as our audience today, and we will send this out to you when he's finished saying what I think he'll say, so that you can then send it on to your buyers so that they will have a sense of how to think about this differently. So Doug Duncan, okay, is it a good time to buy a home?
Oh gosh, just get to the point, So if you have a family budget, I think that phrase has preceded every answer that I've given. If you have a family budget, and at today's interest rates and prices, the house that you would like to purchase fits that family budget, then you are buying a home. And if rates go up, you've locked in a better rate than what the market was going to offer you. If rates go down, you'll have an opportunity to refinance that mortgage. But if you are guessing on where prices or interest rates are going to go, now you've become a speculator. Some people can afford to be speculators. Most people, particularly in the first-time home buying space, not so much. So if you have a family budget, and I ask that because you should have a family budget, because what Pat and his team are going to ask you when you come to meet with them about a mortgage is things that come directly out of your family budget. It'll be a much better conversation because you'll know as much about yourself as they're going to want to know. And it's a much easier conversation.
Well, Doug, I have a special gift to share with you today, or to invite you to understand has taken place. As a result of that question over the years, and as a result of your answer over the years, we built and launched in February of this year a program called Supreme Essentials for Home Buyers. And it was inspired, to be honest with you, by you. What is Supreme Essentials? It's a 20-minute budget essentials specifically built for the home ownership process, so that the value of not only buying, but of owning the home over time, maintenance costs, taxes, insurance, et cetera, would be built in. And then separately, that it sits aside budget essentials, credit essentials, so that people would know why their credit score is what it is, because people pay for interest that they could potentially have lower interest costs if they knew how to control their credit score a bit better. And so we launched this, Doug, in February of this year. We have currently 928 agents who are co-branded on it and marketing it on social to their customers. And as importantly, in the last 2 months, we've closed 250 customers who have taken budget and credit essentials. Again, less than 40 minutes. They take a test at the end. We give them $1,000 credit for their mortgage to, in fact, execute budget and credit essentials. And our agents are marketing it on our behalf now, which the NAR issue requires agents going forward in the future to create a better sense of defining value for their relationship with their customers. Supreme Essentials has done just that. I want to thank you, Doug, because I owe you royalties. I don't know how I'll pay them to you because you work for Fannie Mae, so I probably can't, but I'll at least owe you the best bottle of wine you ever bought. And for our audience, I want to share with you one other really important piece of news. Our mission is to serve others before self and supreme. And we have indeed been paying close attention to and empathizing with the NAR happenings. And we are in the middle of building, which will be a release late this summer, something called the Supreme Homebuyer Journey, which will be a digital program that you can co-brand with us, again, like Supreme Essentials. And it will take a step-by-step roadmap, milestone by milestone, for buyers that are buying homes so that they can, in fact, be educated by you with the tool every step of the process so that they can maximize the biggest investment they'll ever make in their lifetime. That's Supreme Homebuyer Journey. Stay tuned because that'll be released late this summer. Doug, thank you so much for who you are and for what you do for the community of folks that I'm involved with, because we just got doused with education that will allow us to be better professionals and serve our customers in a better way. And I know that matters to you greatly. So I appreciate your friendship and I appreciate you.
Great being here. And thank you. I appreciate the same things with you. Very much so.
All right, Douglas, till we meet again.
You bet.